All right, let's look at the stock market today, and there's still um, some pretty serious concerns, even though we are coming out of this. Um, Actually, this is a yearly cycle low. The advanced decline line. There was a bit of a concern right here when we made a higher high, and that the advanced decline line did not confirm that higher high. So we already had a divergence in the advanced decline line when we made this break to new highs here. So this is potentially like a false breakout that maybe was kind of manufactured by big money to get out of the way. They were seeing the buildup in at the borders of Ukraine, and kind of manufactured an exit for themselves, and then we get this pretty severe move down into the yearly cycle low, and now we've got another intermediate rally out of that low. But as you can see here, the advanced decline line is it doesn't look like it's going to come up here and make new highs. So potentially a big warning sign. Usually in a healthy market, the advanced decline line will move to new highs first, and then the indexes will follow. If this flips the other way and we get a test or new highs in the S&P, but the advanced decline line is lagging badly, then I would be very suspicious that this is, as I've been saying, a manufactured rally to kind of sucker retail traders and hedge funds into buying the shares from smart money, big money that sees a recession coming. So right now I'm kind of assuming that this is probably going to be a false rally to allow smart money to get out of the way ahead of a recession. Next chart here, this is the money flows. This is also quite concerning here in that the divergence here is no big concern. This often will happen at an intermediate top. You'll get a divergence in the money flows on the weekly charts. So that's not that big of a concern, but I would expect, as we're coming out of this yearly cycle low and in a fairly powerful move out of this yearly cycle low, I would expect this to the money flows to correct and turn positive very quickly, similar to what they did right here, almost pretty quickly coming out of that low. The money flows started climbing again into positive, and we're kind of right now we're kind of stuck in the negative money flows, which would suggest again that maybe smart money is selling into this rally and preparing to get on the sidelines ahead of potentially a bear market. The big problem, of course, is oil. I've said this many times in the past. When the price of oil surges like 100% or more in a short period of time, say a year or less, the inflation is usually too much for the middle class and the lower class, and they start to clamp down on discretionary spending, and then that's what causes a recession. And we went from just a little over $60 in late November till right after the elections to over to $130, and that's just way too fast and way too much of an increase in energy and inflation, and I don't think the middle class and the lower class are going to be able to hold up. Now, if I've said in my previous videos, if this were to crash back down to 70 or 60 bucks really quickly, we might save the economy and maybe we would be okay. I doubt that's going to happen. It does look like oil is moving down into probably an intermediate decline here, but I would expect that's probably going to unfold maybe as just a volatile sideways churn with a slight drift lower. maybe a little below $90, and then once that intermediate decline is over, we may go back up and test those all-time highs at 147. And I think if we do that this summer, I think there's no escaping a recession starting later in the year. And also the yield curve has fully inverted on Friday. So a lot of warning signs out there. I think you need to be cautious with your stock market and your retirement accounts, especially if they are in stocks, the general stock market anyway. It's very possible that this is kind of a manufactured rally to allow big money to escape ahead of a coming recession, and a lot of the signs are starting to point toward the strong possibility of a recession later in the year.